All right. Hello, everyone. Welcome to Options 101, Understanding Calls and Puts. My name is Brian Overby. I'm the Senior Options Strategist at Options Play. We have an event set up for you. The 2 weeks ago, we went through what a call and put option is, and we got into some detail on buying calls and buying puts. Today is a little bit of a continuation of that, and I do believe that if you are just learning about options, before you get really deep into the strategies, you got to learn a little something about pricing. So today's event is going to take about 45 minutes, depending on the Q&A at the end, and that makes a good point that if you do want to participate via the Q&A box, please do click on the box that has the question mark. That is open for you. The chat box is not available. That's only for the panelists and the hosts. So the Q&A box is open, and if you have any questions, we'll try to take them alongside the event, but I'll address most of the questions at the end of the event. So welcome to Options 101, Understanding Calls and Puts. Before we get too far along, we got to let you know that options do have risk. Anything that we show you today, we're going to show you some live securities, and it's not meant to be a recommendation. We're just going to talk about option pricing. It's not a solicitation or offer to buy or sell any of the securities that we show. And if you are a first trade client and you want to trade options, you do need to read the characteristics and risks of standardized options. PDFs are all available throughout the First Trade site. You can call and ask them if you would like a hard copy, but past performance is not a guarantee of future results, and you want to make sure that if you are trading options that the risk parameters are understood and realize that you can lose your entire investment by trading options. All right, so here's a slide from 2 weeks ago, and it's just the basic option positions. We got into the minutia of rights and obligations and went through a whole scenario in the last presentation that we did. But I'm just going to show you this slide to just do a quick review of the basics. Today we're going to focus mainly on the buyers of options. So if you are the buyer of a call option, that means you have a right to buy an underlying security. You can buy up to 100 shares of the underlying security, and that's the normal size of an option contract. And once you buy that contract, you are considered long that contract inside your account. So if I'm the buyer of a call, I have the right to buy. That usually means that I want the underlying market to go up if I'm looking to buy stock. On the put side of things, if you buy a put, you have the right to sell. And puts are very hard to talk about and even ask questions on, because when you buy a put, you mean sell. Buy means sell. Well, if I'm buying something with the intention of selling it at a later date, that means that I am bearish on the underlying market. So if I buy that put, I have the right to sell. I want the market to go down. We're going to focus on these positions, and we're going to focus on pricing. Now, on the other side of the coin, we went into a lot of detail on this, like I said, a couple weeks ago, but the seller takes on the obligation. So the seller actually is also considered the writer because they're writing the contract. But once they sell it, they receive premium, and for that premium, they take on an obligation. Once they've sold that option contract, they're considered short. Now, obviously, if you're buying a call and you want the market to go up, if you sell a call, you want that market to go down. So that would be a bearer. You want the opposite position of the buyer. And on the put side of things, that's also true. You buy a put, you want the market to go down. You sell a put, you want the market to go up. You receive premium, you take on an obligation to buy that stock if that stock goes down. All right, if you'd like to know more about that, please go back and look at First Trade does a wonderful job of archiving all the videos, and you can go back and easily find this information if you'd like to review the basics and the terms and conditions of an option contract. So I'm going to make this more about pricing today. So if we look at this contract, and this is once again a slide from last week's presentation, but the biggest thing is this is just an option contract. We got fake stock XYZ, which is no longer fake. It's actually block trading. They grabbed that symbol, which screwed up all of my slides. But with that said, XYZ, December 17th is the expiration. We have the 70 call. It's trading at $3.17, $3.10. So everything that's in here shows up in the pricing of an option contract, right? You have the price of the underlying stock. that matters. You have an expiration date. Time is money. The more time you have, the more costly the option will be. You have the price at which the underlying will be transacted. If it's a call, it will be bought. If it's a put, it will be sold. If the transaction occurs, if it is exercised by the buyer. And then you have a price. The price is actually referred to as the premium, and we talked about this in the last event about the synergies between the insurance world and the options trading world, and that's why they call the price of an option contract the premium. Just like if you're paying your car insurance, you're paying your car insurance premium. So if I go look at an option pricing calculator, you'll notice everything that we mentioned is inside that calculator. And I'm going to compare this to buying car insurance. I'm going to talk a little bit about these synergies that happen and how you would price your car insurance, just like how you would price your option, and how you can develop realistic expectations as to how your option will move relative to a movement in the underlying stock. It doesn't matter if you're buying calls or if you're buying puts. We're going to focus on the call side of things because, like I said, puts are a little bit harder to understand because buy means sell as opposed to buy means buy with call. But let's talk a little bit about the insurance contract and how you would price that asset. So the asset, we have a car. Is it more expensive to buy insurance on a Ford Taurus or on a Bentley? Obviously, the more expensive the underlying, the more expensive the insurance is. So the price of the asset matters, and that's also true in the option trading world. The stock price will matter. The more expensive the underlying stock, the more expensive the option contract will be. Now, I want to talk about pure insurance here. You're thinking of a car insurance contract, and you're looking at the price of the asset. Let's talk about a protective put, and that's the thought I want you to have in your head as we work through the pricing. A lot of people that come to a basic options seminar, they come with the thought that I'm going to learn how to speculate on options, and that options are a tool to leverage your money. But options originally came from a need to protect something, and hence all the synergies with the insurance world. So the perfect thought as far as protection in my mind is the protective put. You own the stock at 100, you buy a 95 strike put that has, let's say, three months remaining until that expiration. 90 days, we'll make it simple. And you buy the 95 strike put. Stock goes up, that's great. You own the stock, you're making money on the stock. Stock goes down, well, you're losing money on the stock, but it gets below 95. Let's say it goes down to 90. You can take the stock at 90 that you own, it's now trading at 90, and put it to somebody at 95. That's a protective put. And let's talk about that in terms of pricing. What would that contract be trading for? All right. So if the stock is at 100, just like the price of the asset of the car, the more expensive the car, the more expensive the insurance. If the stock is at 100, the stock could go from 100 to 0, which is a lot more risk than if the stock is at 10. It can only go from 10 to 0. So what contract is going to be more expensive to buy? If I'm buying a put option on a $100 stock, it's going to cost me more than a put option on a $10 stock. Strike price. Well, I just mentioned the 95 strike put on our fictitious $100 stock. Well, in the insurance world, it's a deductible. Very rarely do people buy the zero deductible car insurance. Why? Because it's very expensive. That means the insurance company has, if you bust out a headlight, they have to replace it, right? It's the zero deductible car insurance. So if I have a strike price, that is determining my deductible. If I bought the 100 strike put on the $100 stock, that means I got the zero deductible insurance. We talked about the 95 strike put. That means I'm taking $5 of risk on my 100 shares of stock. So my deductible would be $500. And you see that a lot in the insurance world too. A $500 deductible lowers your premium quite a bit. Also does in the stock trading world too. Okay. Time is money. That's simple. A 6-month policy on your car insurance is going to cost you less than a 1-year policy. And expiration, there's many different expirations to choose from in the options world, but the more time you have, the more expensive the policy. Now, here's one that a lot of people don't think about, though, is carry costs, interest rates. If you pay for your car insurance, do you pay for it at the beginning of the term, or do you pay for it at the end of the term? You pay for it at the beginning. And hence that means that over the life of the policy, the insurance company actually has your money and can earn interest on it. I know it's a little bit not as intuitive as you would like, but yeah, they get your money. They're that money they're earning interest on, and you're not. Okay, so that matters, especially if you're looking at an insurance company with multiple policies. That can add up to a lot of dollars. So half a point up in the short-term or in the risk-free interest rate can really add to the bottom line of an insurance company. In the options trading world, the interest rate and dividends, the stock actually pays a dividend. Where if you drive your car, you drive your Ford Taurus around, it doesn't say thank you for driving me, here's some money. In the stock world, that happens. Sometimes there's dividends. So you pay for your option contract up front if you bought your put option as protection. The seller of that option contract then gets that premium and can earn interest on the premium over the life of the contract. So interest rates matter. Dividends matter. Stock pays a dividend. That's a bonus to owning the stock. So you own the stock, you get that dividend. That also gets factored into the price of the option contract. It's important that the dividend happens before the expiration date, right? If there's no dividend within the life of the contract, it doesn't matter, but that dividend matters. And now we get to the minutia, right? The level of risk. And we're not going to dive into this as much. We're going to do one more on option pricing. We're going to focus on volatility, but level of risk, it matters, right? How many car accidents have you had over the life of your driving history? What's your job? Do you have a family? Did you just get out of the Navy SEALs? So risk doesn't matter to you. You might drive your car off the cliff as a training exercise, right? And I say that jokingly. But with that said, the level of risk of that driver is why actuaries make good salaries, and it's very hard to become an actuary because they're looking at the statistics and they're trying to figure out the level of risk of insurancing of you driving that car, and that definitely affects your insurance premium that you're paying. In the volatility is the way that we track it in the stock world. How volatile is that underlying stock? How much can that stock move on a day-to-day basis? And if you think of stocks like, let's even look at Walmart compared to Amazon, right? Amazon might have more volatility than Walmart. Why? Because Amazon's got other things that are involved. Even though they are a retailer, they also have AWS, which is cloud services, everything that is involved with that. So Amazon has a tendency to be more volatile than Walmart. So because of that, it's more expensive to buy option contracts on Amazon. That simple, that straightforward. You figure out all this and you use the same type of pricing model to price an insurance contract as you do an option contract. Put all that stuff in, you come up with a premium, and the premium is then quoted, just like we see back here. I'm going to jump back one slide. Oops, I wanted to go back one slide. And that's the price, and that's what you come up with. And it's not simple, but prior to pricing models, it was hard to come up with what is the price of the option contract. And the first one that came out was in 1973, which happened to be the year the Chicago Board Option Exchange opened the doors and first started trading stock options. And it was the Fisher Black and Myron Scholes model, the Black-Scholes model. And that really helped solidify some option prices on the trading floor. But before that, it was all just supply and demand. And that still has a big factor in. But now we can at least say, well, this option is trading for this because we see that this stock is more volatile than that stock. And that has a lot to do with the pricing of the option. Why does this matter? Well, the bottom line is if you put all of these variables in, which we showed you that are already in an option contract via the quote, well, it spits out things that help you understand pricing and help you develop realistic expectations. The most important one is delta. And I'm going to highlight delta here, and we're going to talk about it because I do think, some people might shut down. They're saying, oh, I'm just want to buy calls. I just want to buy puts. And I want to take a directional position on a stock, and I want a way to do that. Well, I don't think anybody should trade these options without understanding how an option will move if the underlying stock moves. And that's what delta does. Delta gives you a realistic expectation of how your stock should move over the life of an option contract if the underlying stock moves. So first of all, if you think of options, an option is a derivative of the stock. So we want to get that clear. That means that it won't act exactly like the stock. Okay, so what does delta do? It tells you the amount a theoretical options price will change for a corresponding 1 point. The definition is unit, but it's 1 point change in the price of the underlying security. So in our example here, we're talking about XYZ stock, and that would be the security. And security is just a fancy word for stock in this instance, all right? So let me ask you a question. So let's go through this, and I open up your Q&A box, and I want to get people to respond to this, okay? So the stock is at 50 and the strike is at 50. We have a 2-month call option. So we're looking at calls. We want the market to go up. We're buying to use the vernacular, we're buying an at-the-money option contract. The strike of the contract is equal to where the stock is at. We see that is trading for $3. All right, so let's do something here. Let's move the stock. Let's say we bought this option, no time has gone away, and boom, the stock went to 51. My question to you is, how much is this 2-month call option worth? Let's develop some realistic expectations. The 2-month call option is now trading for then what in this instance? And go ahead and answer. I like Jan's first answer is correct, but it's not really an answer. It is 3 plus delta. Well, what's the delta, Jan? What's the delta? What do you think the delta is? And I appreciate the quick answer. Go ahead and open up that Q&A box and let's play in this little reindeer game that I've designed. Like 50? Not bad. Anybody else want to join in? I like the like before the 50. That's we could use the approximate symbol. So nobody else wants to play in my reindeer games. All right. Well, Jan's got it right. It is about 50. So in this instance, the stock is 50, the strike is 50. The stock goes from 50 to 51. We see that if we bought the stock, 100 shares of stock, it would have cost us a lot more. But if the stock went up 1, we'd be up $100, right? We'd have 100 shares, we'd make $100. We buy this at the money call option and we make $50, but we paid a lot less for it. So this is where the leverage factor comes in. So we paid a lot less for it. We paid $3 for it, but it's now we made $50 on our call option where we made $100 on our stock if we had bought the stock outright. All right. So I got another question for you. And James had that right too, 3 plus delta, and I agree. And I like that James actually used the delta symbol. I love that. That's the Greek symbol for delta. And now my question gets a little bit harder. So we started, stock was 50, it went to 51. Now what's delta? Let's move it 1 more point. Let's say we're a really good stock picker and the stock goes to 52. Our option is now at $3.50. All right, now what's it trading for? Right? Did it go up more than 50? Did it go up less than 50 in the next point movement? Or did it go exactly 50? Does the delta stay the same as the underlying stock moves? What do we think the option is now trading for? All right, and Jan jumped in right away with 405. James is still hanging in there at 3 plus delta, and I agree. Whatever the delta is how much it should move. And the answer is, Got it. 410. I keep forgetting to click on the slide. All right, 410. So in the next point movement, we went up more than 50 cents. We went up 60 cents in that point movement. We went from 50 to 51, and then from 51 to 52. So guess what? This is reason why people like to buy, first of all, at the money option contracts, and second of all, just options in general. If you are correct in your forecast, you actually pick up shares of stock, right? We started by owning something that acted like 50 shares of stock. It went up one, and instead of making 100, if we owned the stock outright, we made $50. And then when it went up to the next point movement, we made 60. And Jan's question was very very close. Jan came up with 405, about 55 delta, so a little bit more. So I'll accept that answer. That's fine. In the real world, there's a little bit of minutia. This is a theoretical world, but in the real world, yeah, they might have went 55. All right. And so let me explain why this is. And if you understand this next definition of delta that I give you, you might not need to look at a delta again. We're going to take a peek at the actual chains inside the First Trade platform and talk a little bit about delta in there. But if I look at this and I look at this this example, if you understand, if you don't get anything from this presentation, but you remember this next definition that I give you, then we accomplish something. Then we learned something today, right? So here's the next definition. Delta is the probability of the option being in the money on expiration. And I'm going to even add a fragment to this. The delta is the probability of the option being at least 1 cent in the money on expiration. Delta is the probability of the option being at least 1 cent in the money on expiration. Okay, so this is not the correct definition, but this is the way the market makers look on the trading floor. This is the textbook definition right here. But if you understand this definition, you always have a feel for delta. And if I'm buying calls or if I'm buying puts, I'm always going to have a realistic expectation if I can kind of understand that delta is really based off of probability. You're looking at time. Time matters. You're going to look at price, where the underlying stock is at. You're going to look at every delta is taking in volatility. The volatility, then, like all of this stuff is baked into this little number called delta. And let's see what I mean by this probability definition. Okay, if the stock is at 50 and the strike is 50, and you got the 2-month call option, what's the probability of this finishing at least 1 cent in the money on expiration? What's the probability of it finishing at least 1 cent in the money on expiration? Oh, 50, right? If it goes up, it's in. If it goes down, it's out. 1 tick up, it's in. 1 tick down, it's out. So at the money option contracts, we'll have a delta close to 50. All right. Now, there are carry issues, and we talked about the carry issues. So every once in a while, the more time calls will have a little bit bigger delta than puts, but that I don't want to get into that minutia. But I do want to talk a little bit about the fact that if the stock is 50 and the strike is 50, why did this go 50 cents? Because the delta was 50. Now it's dynamic. Like when it was 50 and a half, delta moved a little bit, so it might have moved more than 50 cents, but let's stay in the theoretical. So delta was 50, stock went from 50 to 51, we went from $3 to $3.50. Okay. Now what's the probability of it being 1 cent in the money? I don't know, but it's higher than it just was. It's now at 51. You're 1 point in the money. The odds of it staying in the money has increased and been at least 1 cent in the money on expiration. So in this instance, our delta grew. It grew to 60 cents. And guess what? If we go to 53, it's going to grow more until the delta eventually gets to 1, which means we're very deep in the money and we have something that's acting a lot like the stock. Now, I didn't get a lot of people to play in my reindeer games, but a lot of times when I ask this first question and I say the stock is at 50, the strike is 50, and the stock goes from 50 to 51, some people will say the option goes up 2, right? It goes from 3 to 5. And if that was the case, nobody would ever trade stocks. They would only trade options because you are buying a derivative, paying a very low amount for that relative to the stock, and you're getting more movement than if you bought the underlying stock. So if you think about that, it doesn't really make sense. If you really take a deep dive into it, so the most that delta could ever be is 1. That means that you are receiving the same type of movement as the underlying that it is derived from. So 1 is the highest because of that. It can't go beyond 1. And obviously 0 is the lowest. It can't go below 0. You can't lose more than what you paid for on an option contract. And that's where we're at. So I'm going to take you to an extreme now that we know this. And I want everybody to play in this next reindeer game if we can. We are at the 12:30 mark, so we're going to have to get going here. If you have questions, go ahead and start popping them into the Q&A box. But here we go. Here's the next slide. Delta example 2. All right. Let's make this extreme. We said that a 1-day option contract has a delta close to 50. If we're looking at, if we look at a 60-day option contract, the delta is close to 50. So what if we make it a 1-day option contract, right? The 60-day, the delta is 50. We already established that. There's gonna be some fuzz or some noise in that because in the real world things are a little bit different. But a 1-day option contract also has a delta of 50, right? Well, because you can't get more 50-50 than that. If it literally makes a 1 cent tick and the stock is 50 and the strike is 50 and it ticks to 50.01, it's in the money. And if it ticks down to 49.99, it's out of the money. It's as 50-50 of a option contract as you could possibly get. You go out to 60 days, you got carry costs, you got more days extra, it's a little bit more minutia. But now here's what's more important, okay? 1 day remaining to expiration. We've already gone through the scenario on the 60-day. Let's move the stock to 51. So now my question is, and remember the non-textbook definition, and I've got it highlighted here for you. What's the 1-day option delta now? What's the delta now on the 1-day option contract? Somebody's got to answer. I'm not going to move on. You got to go into the Q&A box. You got to play in this reindeer game. Okay, Jan is stepping up and speaking for all of you that are out there, and Jan says 75. Not a bad answer. Any other answers? Going once? Going twice? All right, the answer is it's going to be about 90. Well, you got to think about probability. Remember, we're talking 1 cent being in the money. Now we're $1 in the money. We got 1 day remaining. And that was a great answer, Jan. By the way, 75 is awesome. But in this instance, it's actually going to go to about 90. And if you look at this and you put this in a pricing calculator, you take a stock at 50, strike at 50, volatility around 25. This holds. This holds true. This is the way it is in the theoretical world. What happened to the 60-day option? Well, we already established. It went to 60. So this shows you that delta is dynamic. Why do people like 0 DTE options? We just explained it. They love the fact that the option moves. So when you're right, boom, you get paid right away. But guess what? When you're wrong, you lose right away too. So you have something happen. And that's why people like 0 DTE options, because something is going to happen. If we go out and look at a longer term option contract, this is even going to move slower, right? This delta is going to move slower over time. So this is what I mean by if you understand the non-textbook definition of delta, you can always have a feel for delta. You can understand why people are intrigued to trade 0, basically 1 day worth of trading, 0 DTE option contracts. And it's all about the explosiveness of that option as that 1 day erodes. And this is that example. All right. So I actually put a little table together, and then we're going to take a quick peek at the deltas inside the options, or inside the, I was going to say options play, inside the first trade platform. But so XYZ are fake stocks at 103. Here's an 8-day options. This was a real underlying stock, not a fake one, but I took real options and options premiums, right? So here the stock's at 103. The 100 strike call is just in the money. You could buy the stock at 100, sell it at 103 on the call side, trading for $4. The delta was 76, right? Why? Because we're deeper in the money. But guess what? If we look at the 42-day option, there's more chance of it to get out of the money. So the delta actually goes down in this instance. I lost my connection on my camera for a second. If that goes away, that's no big deal. All right, so in that instance, is everybody seeing? Yeah, we're not seeing it. Let's just leave the camera off. Okay, I don't know why that just happened, but that happened. Okay, XYZ, I digress. XYZ at 103, we have an 8-day option contract. The in the money option has a higher delta than this option. Why? Because you're in the money with only 8 days remaining. The chance of you remaining in the money by that expiration is much higher than 42 days, right? Because it could go out of the money. It could move 3 points easily, or let's call it 4 points to the downside and be out of the money. So the probability is higher on the short-term option. The exact opposite happens when we get out of the money. The 110 call option has a 7 delta. Very low probability. It's got to move about 7 points in order to get to the 110. Here, time is your friend. You got 42 days to get there. So the delta increases on out of the money option contracts. So what does this mean? This means that how do I apply this to my trading? If I am buying out of the money option contracts, if I'm speculating, to me that's the most speculative trade that you can make. I don't care if you're buying an out of the money put, speculating the price will come down to your strike, or an out of the money call, speculating that your stock will come up to your strike. If you are doing this, if you are buying these options, I don't mind paying more time premium, because along with the time premium, I also get a decent delta. So I pay more. I can't buy as many. I don't sound as good at the cocktail party, right? Because this is a $1.70 option. This is a 20-cent option. This costs you $170. This costs you $20 on a one contract basis, plus commissions, if you have commissions. And on top of that, if I do this, when I do this trade, I actually get more stock price represent. This acts like 28 shares of stock as opposed to 7 cents. Now, the leverage factor is still here, but you also have time decay. You have other variables that are in. But bottom line is, I don't mind buying a longer term option out of the money and selling. I could buy this 42-day option and sell it 8 days later, right? I don't have to hold it for 42 days, but I get a slower rate of time decay and I actually get more delta. I still, if I'm going to be right, I want to own this one, right? If the stock's going to get to that strike and go beyond, I want this one. Why? Because it didn't cost me anything. But if I want to be safe and I want to be prudent, buying time gets me a decent delta, and I have more days to be right on my forecast. If I'm going to be right and I know it, I have insider trading, LOL, and I know that stock's going to get to 110 or beyond, I want to buy the shorter term option contract. All right? That's simple. That's straightforward. Any questions? All right. Let's take a quick peek at the option chains inside the first trade platform. My name is Brian Overby. I lost my video for some reason, but on X you can follow me at Brian Overby, optionsplay.com, and my book is actually called The Options Playbook. All right. So let me get out of this. I'm going to escape the full screen here. Run over to the first trade, and I just pulled up Walmart. You know, I did an example on Walmart, and I just kind of, you want to try to pick stocks that are in the same price range. You know, Amazon's a little bit more, but this is the Greeks and analytical chain. You have calls and puts, which is the default, and a lot of people probably don't dig too much deeper into here, but this is the actual Greeks chain inside the first trade platform. And we have the front month highlighted, right? Walmart right now is at 126, so we have a 126 strike put. And so in this instance, if we look at the delta of this contract, we're a little bit in the money, and we see that the delta on the shorter term option contract is 54.54. Now, if you represent that on a 100 shares basis, it means the delta would be 54, but the actual delta is 0.54 per share. Each contract represents 100 share, so a lot of people would reference this as a 54 delta. I just want you to understand that, okay? So this is the delta on the call. So now let's go and say, if the delta is 54 on the call, what should the delta be on the put? This is our first time talking about puts. What should the delta be on the put? Well, it has to, I see this anonymous attendee. I'll address your question. But it has to add to 1, right? In the theoretical world, if there's a 54% chance that the call will be 1 cent in the money, guess what? There's going to be a 46% chance that the put would be 1 cent in the money. The call's 29 cents in the money right now, the 126 call, right? The 126 call, I should probably click over on this side. And the 126 put is on this side. So if I do that and I look at, I didn't mean to click that, go back down. And if I look at this and I see that this is 54, well, this should be close to 46. And watch, this scenario will hold true, especially on the shorter term options. There, it's the probabilities are a little bit easier to figure out than on a longer term option. But this one's 41, that one's 48, this one's 28, this one's 72 if you round up. Right? So they got to add to 1. And now the only other thing that I want to highlight here on these chains is that the put delta is negative. If the stock goes up 1, the put loses, in this instance, 45 cents, right? Because the put wants the market to go down. Stock goes up 1 on the call, 126 call, you make 54 cents. Stock goes up 1 on the put, you lose 45 cents. But on an absolute basis, 45, we'll call it 46, we'll call this one 55. 55 and 45 adds up to 100. And that's normally the case. All right, so now one more reindeer game. Let's look at the 128 strike call. We'll just focus on the call. We got the February 27th expiration, which is this Friday. This Friday is the expiration date. If we look at this delta is 28. This delta is 28. If I look at, let's go all the way out to June. Whoa, that's way out in time. The June 18th expiration. Is this delta going to go up, go down, stay the same? The 128 strike call on the June 18th expiration. So you can answer with one of 3 answers. Up, down, stay the same. We got 1 up. All right, well, the answer is that it should go up, right? You have a short-term option, 1 day remaining to expiration. The delta is 28. It's going to have a tough time getting there, and the delta is showing that. It's going to, with 1 day remaining, you got all day Thursday, all day Friday. You're going to have, 0 DTE would be Friday. With that said, the delta is 28 here. If we look at June contract and we scroll down, of course we don't have the 128. All right, so we got to look at the 130. All right, the delta is 11, and then I didn't anticipate that. I should have thought that might be. And then the delta here is 48. So big difference. Let's close it up. Let's get rid of the June. Let's go and look at something that would probably have a 128. Let's look at the March 27th. Yeah, so here you go. The 128 call is 45. So going out 29 more days puts this delta, or the probability of finishing 1 cent in the money, at 45 versus 28% chance on this near-term February 27th expiration. So let's do that again. 45 strike call, right? Or I'm sorry, the 128 strike call has a delta of 45. The 128 strike call here has a delta of 28. So in that instance, this highlights that if we are on a 30-day basis versus a few day basis, the delta is going to change and the delta is going to be dynamic. Now, the opposite side of the coin, let's go a couple points in the money. Okay, 126 is here. Let's go down to 124. Look at this delta. 124, that delta is 0.77. Let's go to 124 here. 0.67, 0.61. All right, delta goes down on the 29-day option. On the 29-day option in this instance, right? Why? Well, more chance for it to get out of the money. So you get more action on the near-term option contract. Now, once again, I'm not saying that you should buy and out of the money. You should only buy in the money. There's no golden book of answers, but you should understand this concept. You should understand that probability has something to do with how your option contracts will relate. All right, and so now and I'm going to have to close up here. We're right at 12:45, but anonymous attendee said, please explain deductible again. So let's look at this chain and talk about the deductible. Let's get rid of the February contract. All right. And we're going to look at puts. We'll say we're buying the 122 put, and I'll put it down here so that we can see the price of it. We see that it's trading for $2. Let's call it, well, 197 on the bid, 225 on the ask. Let's round off to $2. So this strike is the 122 put. The stock is at 126.29. 126.29 minus 122 is $4.29. So if I own 100 shares of Walmart and I buy the 122 strike put, that would be a protected put on Walmart. That would allow me, if the stock went to 120, to take the stock at 120 and put it to somebody at 122. And I'm going out 29 days to the March 27th expiration. That deductible means that from 126.29 down to 122, that's my risk. This put does not help me in that range. It's got to go below 122 in order for me to be able to exercise and get benefit from the put. Now, here's a little bit of a caveat though. If it did go down to 124 and say it took half the time, it did it in 15 days, we got a 30-day option, did it 15 days, I could still capitalize by selling the put option. I still have the ability to actually sell and close that put option if I would like. So just keep that in mind that I could do that. But now for this protection, the insurance company, right, the writer or the underwriter of the contract, and that's why sellers are often referred to as writers, says you got to pay $2 for that right and that benefit of being able to fixate your price to sell the stock at 122. All right. And then I have one more from anonymous attendee. Why delta increase 0.5 or for a 1 point increase on the stock price as per the definition on a 1 point increase in the price? It is the stock price. Okay, so it's actually the textbook definition is a 1 unit. In other words, you can decide what that unit is and you can adjust your calculator accordingly. But all the pricing calculators I've ever seen always do 1 point movement in the stock price. Remember, the option is derived from the stock. So the price that matters is the stock. And then you need to see how much representation you get. And that's where delta gives you that realistic expectation. Okay? And I don't see any more questions. And we've gone a little bit long. So I'll run back to here, give you my information. Name's Brian Overby. Handle is at BrianOverbyOnX.com. Check out First Trade, the awesome sponsors of all this education that is available. Wonderful web. I love, like, other things that are inside that website is you can adjust interest rates. It's actually a pricing calculator, which is awesome, and I do love that about the First Trade option chains. And we learned a little bit about delta today. And if the only thing that you get as a takeaway today is that delta is really based off of probabilities, and probabilities are important in option prices, you would get a good feel for it. So now we'll come back, and if you need to watch this again, go back and do it. Now, this is supposed to be a basic option trading, but I really, 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 really feel that before anybody starts doing trades, you need to understand a little bit more about how the prices react on your options. So even though delta can sometimes scare somebody, if you're going to trade options, you need to take the time to learn it and develop that realistic expectation. And delta is the easiest way to do that. Get that realistic expectation as when the underlying stock moves, how much will my option move? And after today's event, if you never look at a delta again in an option chain, I'm okay with it, as long as you kind of understand that once it gets in the money, it's going to react more to option price movements, and once it gets out of the money, it's going to react less. And you get that takeaway, then you can help you determine what option contract you want to buy. My name is Brian Overby. Thanks for stopping in today. We'll see you again shortly for another educational event sponsored by First Trade. And I always like to leave you with, well, if you are buying options, I hope that they always finish in the money. And if you're selling options, I hope they always finish out. Thanks for coming, everyone.